When you're young and dumb, you don't really think about the risk. You have dollar signs in your eyes of what you could make. I didn't really appreciate the risk of building those houses. And I would argue that the risks that I took in building those two little houses was infinitely higher risk than what we did on that KPMG building. We had very sophisticated sponsors, real leases, real cash flows.
Imagine starting your real estate journey while still in law school, burdened by student debt, and eventually turning dials for dollars into a billion-dollar empire. Most people in the real estate investment industry rely on a complex web of upfront fees to stay afloat, regardless of whether their investors actually make money. Our guest today decided to throw that model out the window. He put the risk entirely on his own shoulders, proving that by aligning his success directly with his investors, he could go from an industry outsider to being trusted by the world's largest institutions. Today, he reveals the crawl, walk, run evolution that allowed him to move from a single opportunistic deal to managing a massive portfolio with scientific precision. Welcome to today's episode of Your Business Growth Podcast. I'm your host, Jeremy Shapiro, author of Your Business Growth Playbook, and my guest today is Ari Rastegar. Ari, welcome to the show.
Thanks, Jeremy. I think you explain it better than I do. So if you'd like to come to some of our investor meetings and share that next time, we'd be happy for you to be a guest and explain it like that.
Love it. Well, Ari, take us back to the beginning. You started out, while in law school, jumping into this world of real estate. How did you make that initial leap into real estate while still also being a student full time?
Other than insanity and, mental health issues. And no, look, the timing was very interesting. And the time at 2006, 2007 should tell you everything. And, being in San Antonio when I was in law school, driving back and forth to school, it was very easy, to get mortgages, to get loans, and not necessarily for me. I mean, I had basically no income and, a bunch of student loan debt, but the operator and the developer, who's still a very good friend of mine, Mitch Dugan, really governed this little part of northern San Antonio. It's called Spring Branch. It's not exactly San Antonio, but Spring Branch is kind of the northern district, and it's blown up since then. And, he was building these single family kind of second homes for people very close to Canyon Lake. And driving back to school, I lived in this little neighborhood that had a bigger house where I could kind of study and sprawl out, which was, cheaper than living very close to campus. So I drove about 30 or 45 minutes back and forth to school, which gave me a little time to, kind of think and, back and forth. And I kept seeing, his signs go up before I knew him. It said, Dugan Construction for sale. And then on the way back home, effectively, it said sold. And so this was my trip back and forth, for several weeks. And I just kept thinking, I was like, geez, sold for sale, sold. And finally, I picked up the phone and I called, one of the, effectively like one of the real estate brokers that's name was on this thing. And I was like, well, how much is that lot? I had curiosity. I saw, there was just framing going up. And over the course of this time, I saw houses complete or almost complete, starting, existing houses sold. And I was like, well, how much is this lot? That was really close to my house. So where I lived, it was within walking distance. And there was a few in the middle of construction, a few that were completed, and a couple lots that were for sale around other bunch of houses that were already completed and sold. So it wasn't like rocket science for me to think, well, if that one's sold already, and this lot is here, and that one next to it is built and sold, and so there wasn't like some, precision underwriting, like, running a spreadsheet. It was like, how much is that? And they're like, oh, it's $3,500. I was like, that lot is $3,500. I was like, yeah. And I got to just doing a little bit of math, but again, nothing that you would think, like some underwriting, like I'm an English major. Like I was like, looking at it, and the house sold for, $115,000, $120,000 next to it to tell you kind of the pricing. And I was like, well, the land's $3,500, and, just doing some rough math, I was like, I guess it probably will cost $80,000 or so to build it. So they're making, I'm just kind of doing this in my head, like thinking about it. And finally, I had about $8,000 in scholarship money and student loan money that was, I hadn't necessarily draw down it, but had access to it. That was for living and for stuff. I got a $10,000 scholarship that year to go to St. Mary's School of Law. That now I'm on the board of trustees. Many years later, the dean is a dear friend of mine. We do this incredible scholarship in the name of my previous dean, Charles Cantu, that was actually the longest sitting Hispanic law professor in the United States, which is a pretty incredible feat. Still one of my dear friends. We text and talk. And if it wasn't for him kind of changing my course curriculum so that I can kind of work from home and have some self-paced studying, none of this would have actually been possible. And so just having those dialogues, I saw Dugan's name and I just showed up at his office and I was like, hey, I saw that you built this house, and, him and his wife are looking at me funny. And I was like, well, there's a lot here for $3,500. And, kind of rewind a little bit, I ended up just drawing on that student loan money and drawing on that scholarship money and just buying the lot completely sight unseen. Basically no effective due diligence other than the houses next to it were already built. And I went in and I was like, hey, there's a lot here next to whatever. They're like, yeah. I was like, yeah, that's sold recently. And I'm like, and it's like, you bought that? I was like, yeah. I was like, why? I was like, well, to build a house. He's like, oh, you're going to build a house? I was like, well, about that, I don't really have any money. And I see Security State and Trust Bank finance the house that you built. I was wondering if I put up the land, you help me get the loan, and we'll split the profits 50-50. And by the way, that model has basically still stuck in some regard 20 years later, where, we'll put in a certain amount of equity, we'll get the debt, and we'll split the profits with our investors 50-50. No other fees, no other acquisition, just simply we put up equity, we borrow the money, investors put in cash, we split the profits. And after realizing that I wasn't kidding, he was like, yeah, that kind of makes sense. So the land became our equity, and then you can get really high leverage loans. So he didn't have to put any cash. And in hindsight, he's building them, making money on the construction, and he's developing it. And so we did it. And so every morning around 5 a.m., 4:30 or 5, I showed up at the build site and not really knowing what I'm doing, working with the construction workers. And it started from them saying, you stand over there, you don't know what you're doing, to being allowed to carry like sand, and then being allowed to carry bricks, and then all of a sudden turned into tying rebar, and then to pouring foundation, and then driving to school, and then working, studying, coming back, and then basically felt like 24 hours a day. And we got the first one completed in about 7 months, and sold it during construction for $115,000. And made money, and then immediately bought another lot, right there, right within a block or so, and did it again and built it. And we sold the house like basically right at completion, right around the end of 2007. So that should tell you what happened to financing and happened to the world. And effectively, right after we sold it, within a few months, the markets collapsed, and all those financing, all that stuff that was available for those two houses disappeared. And so I had to give some real thought to taking the bar exam, and which I did, and took the bar exam, passed it, and the markets were destroyed. So I gave some serious thought to practicing law, which I did. And I got a job with, one of my old bosses that I clerked for during college. I clerked for, actually in high school too, one of the most famous criminal defense lawyers in Texas history, still a very close friend of mine, and worked for him. And he got me a job at Dallas County as on the wheel, which is effectively what it means when indigent clients don't have enough money for an attorney and the public defenders run out, which they do. They'll give a small stipend of $250 or $500, depending on the case, to private attorneys to represent those clients in misdemeanors or felonies. And usually you have to be an attorney for 10 years before they'll let you be on the wheel. But throughout my time in high school and in college, I'd sat in on dozens and dozens of felony jury trials, murder trials, high-level felony cases, and done the briefings, done the research. And based upon my experience, John got me on the wheel because he basically said, Ari has more experience as a criminal defense lawyer than most of these people would in 10 years. So over the course of the 18 months or so that I practiced criminal defense law, I did something like 70 felony jury trials and was at sometimes doing 5, 10, 15 cases a day in terms of pleadings or working with clients. And yeah, and after that, the world, there was a couple little twists and turns that got me into the entertainment business that I wrote about in my book a little bit. And the first person that financed my entertainment business, which ended up blowing up, I wrote a whole book called The Gift of Failure about it, is one of the most decorated financiers in the history of commercial real estate. Has probably done $500 billion in real estate finance. He's financing, One Beverly Hills, which is, going to be the most expensive cost per foot condo development in Beverly Hills ever. He's the president of Newmark. And he financed my entertainment business, which blew up. And after it blew up, I had some real thought about going back into real estate. And at that point, I entered as a fund to fund on the private equity side.
Nice. So what I'm hearing there, Ari, is that early on, you were really getting your hands dirty from putting in your own money, your own sweat equity, pouring the cement, bending the rebar, doing all of it. But that initial taste of real estate, it sounds like gave you the taste, but that wasn't the immediate direction. Bring us to the point where you were getting involved in your first bigger deal, like you're talking about, the KPMG building in Dallas. Like, how'd you manage to raise all the money you needed in equity so early on with such a big project?
It's a great question. It was the project is one of the most incredibly structured deals I ever worked on in my career, because what had happened was it was basically a vacant office building. And the sponsors had got a hold of the deal, but it was vacant and wouldn't pencil at the existing cash flows. So we went to Cantor Commercial Real Estate, which was a CMBS shop at the time. And that basically Cantor Fitzgerald, the CEO, Howard Lutnick, who is now our commerce secretary, ended up doing a pretty incredible deal to buy BTG, buy Newmark, and create a CMBS business, which is effectively the bond business. So Howard being the king of bonds, effectively thought, well, look, if we can originate this debt and we can sell the bonds, there's a bunch of fees there. It ended up being very smart. And Barry Gossin, the CEO of Newmark, who's still the CEO of Newmark, I mean, they've expanded profoundly, but this was kind of the beginning of what their CMBS book would look like. And mind you, this is after, loans are just starting to get written again in 2009, 2010. So right around this time, 2011, 2012, these buildings started to come back, loans started to be written, and the sponsor, had an incredible relationship with Vista Equity Partners. So who the CEO, Robert Smith, one of the richest African-American men in America, incredible business person, was buying all these software companies. And so the idea was, if we could go in there and get Vista to sign a few 100,000 square feet of leases, we'd be buying the property at distressed pricing, distressed vacant office pricing, before office really blew up. Now Hilltop Securities is actually in that building, which was KPMG's headquarters at the time. So when you drive by, I was actually in Dallas the other day, because as we know, we own the land at 1899 McKinney Avenue, which after 8 years of rezoning will build the tallest building ever built in Uptown, across the street from where Goldman Sachs's big office and the new Texas Stock Exchange is, to where from that vantage point, you'll be able to see, where that KPMG building was, 717 North Harwood. So the plan was, if we can get Vista to take 3 of their companies, sign big leases ahead of time, we could effectively pop the value of the land before we closed and use those new leases that we signed before we closed to create enough value to get a CMBS floater to get in there, get a little bit of extra cash, finish the TIs, finish the improvement, get it to stabilization, refinance the site, and basically pull out all of our equity, within 1 year with permanent financing. And the numbers were intergalactic for real estate. And so I basically said, okay, maybe if I can form an SPV, this could be the launch of Rastegar Capital, to where if I'm not the one signing on the debt and I'm not the sponsor, I could act as a fund to fund and put together a tranche of a few $1,000,000 of equity, put it alongside in the deal at contract level pricing upon sale of that position or sale of the building, which I ended up selling my position early at a massive IRR to get the liquidity to start the company. And that's exactly what we did. The sponsor structure the deal. We worked directly with with Vista and with the CEOs of those software companies. I invested there, and that became the inception of Rastegar Capital, acting kind of as a fund to fund or direct to deal. We sold the thing, and the liquidity from that deal, the liquidity from the friends and family that came into that, accredited investors, lit the match to go invest in another 38 cities, 13 states, 7 different asset classes as a fund to fund with different sponsors. And when all of those deals started to sell out over the next 2 or 3 years, we're talking 2017, 2018, we started to use our balance sheet to attract some institutional investors, use that track record to work with some financial advisors, get on Fidelity's platform, TD Ameritrade's platform, and started to buy hundreds and hundreds of acres of cities, like in Kyle, 50 acres next to the airport, some incredible sites in downtown on the east side of Austin, in downtown Phoenix. And we started to then build a vertically integrated platform that we've now built, I don't even know, millions of square feet, invested in millions of square feet, hundreds of acres. And we have close to, I guess if you build everything we own today, meaning on the land, I guess the gross value is in the billions of dollars of single family homes, BTR, multifamily, commercial, industrial, super tall skyscrapers, self-storage facilities. But it all started, as you kind of said, with one deal that we had the inside track into, structuring it, finding a way to go, and then parlaying that into the institutional risk controls that we have.
Nice. So you were really able to parlay that initial big win, which, that's a risky play, but you made it work. And that really got you into this next level of growth from there.
You don't really think about the risk. You have dollar signs in your eyes of what you could make and what that looks like, but I didn't really appreciate the risk of building those houses. And I would argue that the risks that I took in building those 2 little houses was infinitely higher risk than what we did on that KPMG building, because at least in that one, we had very sophisticated sponsors. We had sophisticated private equity companies. We had accretive financing with really smart people looking at that institutional grade debt. We had real leases, real cash flows, that we really, if it wasn't me fully appreciating the risk, we had some very smart people that were looking at that, and the deal penciled to where that was my impetus into. So yes, there was a lot of risk in putting kind of capital into it, but that was my first entree and really understanding the mechanics of the capital stack and what the debt was going to look like, what the cash flows was, where not net operating income was, buying at a discount to replacement cost, and starting to get into the private equity bones of what's evolved into Rastegar Capital and what will continually evolve into the next phase, which we're working on as well. But all of it has to do with downside risk protection. All of it has to do with, that investor focused, risk adjusted return mentality, which, before I didn't even know what those words meant. Like I'd never even heard asymmetric risk investing, I quite literally didn't know what they were. And, as you continue to peel the onion, you learn these things during experience.
Yeah, and you really were an outsider to this industry getting into it, a pretty well-established space. Like, what was it like trying to learn all this on the go? And like you said, being younger, dumber, taking on higher risk than you needed, and then learning as you went. How was that process?
I think I was too dumb to know what I didn't know. honesty. It was so exciting. Like, sitting across, from these masters of the universe, like the Robert Smiths of the world. And I don't know Robert very personally, but being there and, dinners and meetings with some of his people, the president of his company that left and a bunch of his CEOs, and being there at Cantor around people like Anthony Orso and, Howard Lutnick being one office away. And it was a unbelievable thing. Like I'm going from, literally sleeping on the floor of my little apartment in Dallas, while I was a criminal defense lawyer, and sleeping on my chief of staff, soon to be chief of staff's couch, already a lawyer, to within a blink of an eye, literally within a year, living in New York City on Wall Street in a brand new building, being in the room with these types of names. Like, I was just, and this is before really YouTube or Google. You couldn't really look this stuff up as much, to where just listening to what it was and hearing it, and then talking to Anthony on the side and be like, what's NOI? He was like, oh, net operating income. I was like, okay. Like, literally it was learning through osmosis. And as I'm looking through the deals and penciling them, talking with the partners, talking with the debt people, and trying not to act too stupid, it'd be like, oh, the net operating, what's the coverage on, what's the rate? What's a floater exactly? Like, and literally learning it as we were doing it. And some of it was so exciting, a little bit scary, but mostly so invigorating, that I almost had to pinch myself sometimes, of being like, look at the people that are standing around here, and trying not to talk too much and listen more, and learning as it was happening.
Are you enjoying this episode? Make sure you hit that subscribe button right now. That'll help you get more episodes automatically as soon as they come out. So hit that subscribe button right now. And if you have a minute, leave a quick rating and review. That helps support the show. Yeah, you talk about, I've heard before, like this crawl, walk, run period. And this idea of surrounding yourself with the right people, that you had a chance to crawl next to them and move from there. Talk to us a bit more about this crawl, walk, run model you've talked about.
There's a lot of people that work really hard. And I admittedly have been a very hard worker. Okay. Delivered pizzas through undergrad, got through 2 community colleges before getting to A&M. And then, doing my study abroads and, scholarship money to get into law school and being on the construction site. So admittedly, I have been a very hard worker, and I'm very fortunate that I have my limbs and my health to be able to be a hard worker. But a lot of people work hard and they don't get in these rooms. Okay. So I want to truly say that a lot of this really has been a privilege. And I'm not saying that in some cheeky way, that I don't know how some of it happened. My wrestling coach in middle school and high school, his cousin was Anthony, and I met him at a thing. And so he happened to say, no, you meet Ari. He was he's a mediocre wrestler on the best wrestling team in the United States, but he's a hard worker. You can trust him. He's loyal. And then getting me in that place. So I woke up in the room, with some of these people in ways that it's hard to reconfigure. And yes, did I get on the phone and cold call 40, 50 financial advisors a day before there was a CRM, before, you just literally Google independent financial advisor and just get on the phone with so many people, show up at people's offices with donuts, and I don't know if that world even exists anymore, but the harder I worked, the luckier I got, in some regard. But you crawl, the strategy of crawl, walk, run is, hey, start with something kind of small and see if you can figure something out. And then you kind of walk into it, and then you start, running and getting your bearings underneath you. And I think that is a very human experience. Quite literally, we learn how to crawl, we learn how to walk, and then we're fortunate enough, we learn how to run. And for me, that's really been the learning process of jumping in something I have no clue about, and then inching into it reluctantly, trying again, asking questions, failing, trying, sounding stupid, getting a little embarrassed, and then coming back and try it again. Because that's so much of the process, is that if you're not willing to be humiliated or willing to be very embarrassed or look really stupid in front of really smart people and be able to endure that with grace and go back and do it again, the learning process is brutal. And I think you won't accelerate you're learning if you are not willing to endure enormous amounts of pain and suffering, enormous amounts of humiliation, or at least be prepared to be, because you have to really endure a long time of being wrong or be prepared to be wrong before all of a sudden you look like a genius. And so there's a certain part of this where you have to maybe have some intelligence, you have to have some subject matter expertise or specialized knowledge, as Napoleon Hill said. But then these unforeseen things that are unforeseen. It's like Donald Rumsfeld said something that always stuck with me. He said, there's things that we know we don't know. And then there's things that we don't know that we don't know. And that same process happens when you're crawling and walking and running and counterpunching and trying again, where, you know, when I thought I'd done everything smart and I'd signed these big things and I knocked on the doors and I'd convinced them to do whatever, and then an ice storm hits, you know, and how do you underwrite that? So I've learned to know that we're going to have to endure unforeseeable things. And in the investment business, maybe that means more capital, cash reserves. Maybe that means a little lower leverage, controlling the controllables you can. But being an entrepreneur is so much about enduring psychological and emotional hits that you have to be able to get yourself back up. And we see this in sports a lot, where you take, like, I don't know, LeBron James or Kobe Bryant, and yeah, playing the game is one thing, but the media scrutiny of what that looks like and your family being harassed or endure, whatever it comes to it, those intangibles is where the game is really won or lost, in that inward mental game. And it's why I've spent such a profound amount of time working on my meditation practice, working on my health regimens, being in the gym. And because I find the psychological part of this is 100x more difficult than learning. Like, the Egyptians built the pyramids, bud. Like, building an apartment complex systemically is not that difficult in the grand scheme of things. And a multiple on NOI to underwrite an apartment deal and lease a couple apartments, yeah, it's hard, but lesser men have accomplished more, if you know what I mean. But being able to run your family and go through that, or me going through my divorce and still raising 3 children, or, you know, then rates going up and investors calling you to be, you know, when they're worried about something, all of those intangible psychological resilience pieces, to me, is the part that nobody told me. And that, you know, I didn't know that that was going to be the work. The work is not, you know, buying an apartment complex and trying to raise money. It's when interest rates spike 500 basis points, and investors that you spoke with, and of course in good faith, and signed all this stuff and showed them the documents and you showed them the plan, and then it's delayed a year. And you have to get on the phone and say, look, it's not your fault, but it's your problem. And when people trust you, especially retail investors, you got to pick up the phone and say, hey, I know I said this, and yes, on paper, I did everything right, and we got the right debt, we did the right whatever, but I mean, this rate that was at 4% is at 9%. So we thought cash flows were going to be X, but the rates went up, COVID hit, and things were delayed. And, you know, how you deal with that and being able to get off the couch when you feel like shit and you know, feel bad or you feel whatever, that's the game that of being an entrepreneur that I don't think is spoken enough about, because that's really the work. You know, buying real estate or raising, you know, whatever, that's simple. I shouldn't say easy, but it's simple compared to these other intangibles that require a level of emotional intelligence that's very hard to gauge. But if you focus on it, there are ways to improve it that, like I said, that have been vital to any kind of modicum of success I may or may not seen.
So I want to move on and talk business models, but before we do, just to recap a few things I'm hearing for our listeners. You know, one is that entrepreneurship, business, whatever the model, is not without its risk. You can certainly mitigate, backstop, insure in many ways, but it's not risk elimination.
Everything has risk, Jeremy. By the way, drinking tap water has risk, if you know what I mean. Like walking across, like driving a car, there is risk. You can go get hit by a bus. So appreciating that and understanding, and like you said, mitigating it, absolutely. But there is a risk reward threshold that everything you do in this world has risk, and appreciating that, understanding it, not being in denial is mission critical to any type of success in life, whether investing or in life itself.
Exactly. And so Beyond the risk mitigation, the other piece I'm hearing there also that is so thematic in entrepreneurship is getting out there and doing it. It's not about getting rid of all the risk. It's doing it despite that, right? And then working with the things outside of your control. And you listed a dozen different things there, plus that you've encountered obstacles in the way. And the obstacles don't stop you. It's just something you go, around, over, under, through, but it's not a stop sign. It's really, it's more of a detour. And you've done that.
I'm glad you said that. It is. And the obstacle, and I've heard this phrase used and I love it. The obstacle is the way, and that is the point of leaning in to those things because, Tony Robbins, and I'm admittedly a huge proponent of any type of personal development because I do believe the overcoming is the becoming, overcoming your old self, overcoming your things. And if you're not willing to innovate yourself, change yourself, you have no prayer of being an entrepreneur. The amount of change that happens in your business, if you plan on still being a founder and a CEO, the innovation, the pivots require you to change and evolve. And Tony Robbins said something that I love so much and that fundamentally changed my paradigm about obstacles or problems is that he said, problems are the gifts that we grow from. And in the title of my book, although not the great American novel, hopefully worth the $10 on Amazon, is The Gift of Failure. And I know that sounds a little kitschy on its face, but when I look back and hindsight has that 2020, every huge obstacle, every massive failure, temporary defeat, everything that felt insurmountable, when it was accomplished, what was impossible became possible. Those lessons that were learned, that experience that learned, quite literally are the gifts that you use and the lessons and the tools you use to accomplish bigger problems down the road. So the only people that don't have problems are 6 feet deep. So being blessed to have problems means that you're a human. And the bigger problems that you have means the more responsibility you have and the higher privilege you have to be a leader if you're blessed enough to be a leader. And so if you can change that paradigm, and I'm not saying it's easy, I struggle with it. I'm not saying it's fun. I'm not saying any of that. But if you can look at it in that moment and say, never let a good crisis go to waste, and figuring out what to extrapolate.
Growth almost always happens from being uncomfortable, being in a new, different space, place, etc. And so you've got to put yourself in those uncomfortable, difficult situations to find that growth, to find those lessons. Staying, the stasis is more or less moving backwards.
Organic matter only exists in 2 states, growing or dying. Stasis is not a thing for organic matter. And we see it like in water. Water that's not moving is stagnant and it's poisonous, and so growing or dying is the point. And I also believe, I saw Ray Dalio, and Ray Dalio has been a big, important piece of my life for the few times that I've met him and seen him in person. He's the one that told me about meditation, actually. And he's been a huge meditator, as long as, he talks about, but he has a little formula that I think about a lot is pain plus reflection equals progress. And I would take it a little further and say, if pain plus reflection is progress, I would say progress equals happiness. Because when you are progressing, albeit an inch and you're crawling through the mud or a mile, and I often say that, they call it a step back jumper for a reason. Sometimes you step back to make space and then you make that shot. So you might think that you're taking a step back. You might think you're whatever, but creating that space to open the shot, you might not have the wisdom or the discernment to know it in the moment. But in hindsight, you can see there was space needed to make to go hit that shot. So pain plus reflection is progress, and progress equals happiness.
I like it. That's good. All right, let's talk business model briefly here. Traditionally, in this space, there's like this upfront fee model, and you decided to pivot away from that into a more non-traditional model that's more performance-based. Talk to us about why you made that choice and how that's helped out from a business growth standpoint.
Well, at the beginning, I always have said to the team, and I've said it to myself, I don't want to be in the fee business. I want to be in the performance business. And look, there's a certain amount of fees and expenses that need to be paid. Okay. And there's a fine line between somebody taking a 15% fee for capital raising, and you raise $1 million and, you're only investing $850,000. And then you have an acquisition fee, a disposition fee, a 2% management fee. So there's a fine line between utilizing costs or fees, whatever language that you want to call them. You can call them fees, you can call them taxes, you can call them expenses. Like there's a lot of different ways to skin that cat, but it's money coming from the investors. And I have found that there's a fine line between how you utilize those expenses to run a premier organization. And there's a certain amount of them that are needed. And we'd like to believe that we've created a balance between those reimbursements or those expenses that are needed so that we can best serve our customers and bring them the best analysts, bring them the best due diligence, bring them the best deals in the world. It's like in construction management is a great example. So when you're developing something that is highly difficult, highly technical, there's development fees. Okay. And those development fees I've learned in building Infinity Park, a 600,000 square foot industrial facility that we built here. We sold one of the buildings to the city of Austin Police Department. The complexity that went into that and the development fees that came, those weren't, yes, you can argue that it was revenue and things, but the amount of time and energy that it's being utilized to build a great product is so necessary. When we built Infinity Views on East 8th, office building, same thing, like the precision that goes into there. So I just find that it has to do with the manager, how they view them and what their objective is. But when you look at our promote structures, we have always geared all of our focus to getting a larger lion's share of the deal if and when we perform. And we've been fortunate, and that doesn't work always in your favor, by the way. Like being an investor, you don't make money on every deal. We've lost plenty, especially in these difficult environments. We've lost a lot more than I care to admit. But the winners have exceeded the losers, and that's why you have a portfolio. That's why you diversify and all that good stuff. But I think it's the mission and the mentality around being performance oriented as a team, as a culture, as a perspective, and how you look at things more so than exactly what the fee schedule looks like per se, but saying we want to be rewarded. So when a lot of folks early on were doing 2 and 20s, 2% management fee, 20% promote, and they have baked in there 15% of upfront costs. And I don't think there's anything inherently nefarious about it, because a lot of groups that do 2 and 20s are knocking the cover off the ball and outperforming people that aren't. So you look at some of the stuff Blackstone has done in those early years, or KKR has done, or Stevie Cohen has done, taking a 50-50. He's crushed other managers. So give him a 90% of the profit. He's still beating the S&P. So, so there's something to be said about what are you doing for your investors and what are they taking home at the end of the day? And how does that stack you up against other competitors, or not even competitors, other options that they have from active and passive management? And that's been the way that we've tried to look at it, is we want to be in a place where our profits or our revenues is aligned with our model to our performance more so than anything else. So where if we make a bigger pie, we get paid more. But inherently, that's tied to them making more money too.
So talk to us about how that impacts deal analysis and which deals you choose to get involved in.
I mean, it makes you much pickier, right? Because if you're only going to really make money, real money, if you're going to make money, that's the point of you put yourself in a situation structurally where you have to do more stringent due diligence. You have to really look at the downside in a way. And so I kind of look at it when an organization gets very, very big and continues to scale, the structure itself should create something where trusting just one person to do what's best for an investor or something, people are people. They want to make their bonuses. They want to make their money. There's nothing nefarious about that. But if a team or your investment committee and their bonuses and their money and their payroll is directly linked to how well we do over time, I believe that'll make us do better and better deals. And I hope that to be true. I think that to be true. But continuously to refine our models as we get bigger and bigger and bigger, to be more performance-based, to make our team performance-based, to be a meritocracy as best that we possibly can, and making that the culture, I think leads to being more obsessed over your customers, to create raving fans, to create a better culture where people reinvest, brokers come back and do deals with you. And, because so much of this is a relationship business, and And that concept, a meritocracy, is the word, is the culture, is the point. Do you always get it right? No. Are there deals that you do that you look back and say, absolutely? Are there deals that lose money? Of course. And that's the game. You're not a psychic. That's what investing is. And but that's where our focus is, and that's where our thoughts are.
So you touched on relationships. Earlier on, especially you're talking these early deals, you were very partnership heavy. But you've moved that model to more of this like independently managed $1 billion portfolio. Tell me more about the transition from working with partners to independently owning managing. Like, what was that like?
Yeah, it's really about who could do the job best. We still work with great folks. Like on our massive industrial facility, we had owned the land, we'd come up with the idea, we were putting in a bunch of money, but really nailing it, we needed someone smart. So we worked with Related Fund Management, one of the greatest investors, I think, in New York, that came in and we ran the deal, of course, and it's been very, very successful and, in a lot of different ways. But, we needed eyes to make sure we're executing properly. You needed capital, institutional capital to do it, relationship on the debt side. And so using strategic alliances to do that where everybody can get the pie bigger, we're still absolutely doing. On our project in Dallas, Infinity Tower, 400-foot super tall on a half-acre triangle. Yeah, I'm going to get some experienced developer, co-GP to help us look at that deal and make sure we're executing on it right and not being penny smart, pound foolish to where, you bring some folks in there. The key is to execute on the deal. That's the objective. And when you execute on a deal, you have plenty of time. So what you're seeing is starting out super fund to fund, starting to figure something out, and then taking it on our own back and executing it. And then figuring that out and continuously working with this idea of becoming a vertically integrated firm that does it soup to nuts, but not being in a rush to get there. And every time that we go down the daisy chain, bringing in a strategic alliance on that part that we don't have subject matter expertise, nailing it, getting it right or not, or figuring it out. And once we learn it, keep going down the daisy chain until one day we own the land that grows the trees and the company that cuts the trees and the factory that turns it into lumber and the ship that brings the lumber over. And then
that whole like working the supply chain is a strategy we love talking about in the show, as well as this idea of like when you repeat something enough times, you dial in your systems, you figure it out, you get operationally better. And due diligence is one of those areas I think you've really found some expertise, to the point you have this scientific 100-point system. Tell us about where that came from and how you use that 100-point system.
And the 100-point system I'd like to believe, so it reminds me of a story that, Ralph Waldo Emerson and Henry David Thoreau were very, very dear friends, both transcendentalists. And, I remember that Emerson wrote Thoreau a very long letter, and he wrote at the end, P.S., I'm sorry I didn't take the time to write you a shorter letter. And I can say that about my due diligence checklist over the years, is at the time I took the time to write this long thing, thinking I want to hit all these different things. And over time, it's been whittled down to things that are so much more substantive and so much more, because that clarity is so much more effective than complexity. And at the beginning, you don't really understand that or what that means or what the real value and the real leverage points are. But I can tell you in real estate on its face, and we're very much evolving into a technology company, quite frankly, and so much more of what we're doing is in tech, so much more is, around this, our Infinity brand, our sister brand, Infinity, is very much a technology brand, more than anything else. And even we're starting to make our first investments in startup technology companies and very much evolving into the technologies that plug into real estate, because everything is real estate. You have to be somewhere in real estate. You have to own that foundationally. But my point in saying that is, in real estate, your entrance strategy is really the most important strategy, because that's what you can really control. So much of what we look at is, what are we paying for this thing? What are what is the things that we can actually control? So if you're buying something at a massive discount to replacement cost in a great area, so much of it before is looking at the future stuff, and you can get drunk on Excel models of just turning them around to make a 600 IRR and make 40 times your money. But it's a lot easier, I think, and more disciplined to focus on what are you doing at the outset? What are you paying? What level of value creation can you have on the front end? We're looking at deals now where we'll buy 500 acres as an example, and we already know we have builders that want to buy those lots. So is it a complete done deal? But we know if we get it, we can go through some simple entitlement work. We can finish the lots, and we at least have a base case of our customer of what that's going to look like. So we try to do deals where we can try to now going forward. And I wish we could say this about all the deals we did and we didn't is, who is that end user customer? Can we get some leases on the front end of kind of like the KPMG concept of, can we buy something where we know we have a tenant in tow? Can we buy a piece of land that we know that we can sell a certain amount of lots? And that's really become, the strategy and the technologies that we're investing in. We could be the customer. These are technologies that we see, they make a lot of sense to where we're investing in them because we think if we freaking need it, then a gazillion other people are going to need it. And so we're going through that point where our access to information, our access to companies, our access to capital has widened so dramatically that our customers, that have trusted us in this regard are asking for new things. They're asking to invest in AI companies. They're asking us about fintech. They're asking us about prop tech. And we're basically said, look, this is what the need is. And we are the customer for a lot of them. So if we use our foundation and buy and invest and cultivate these types of companies, we can utilize them for ourselves and also provide them to other customers.
And that's one of the most powerful things in that vertical integration strategy is that oftentimes it's filling a gap you have in your business or taking care of one of your biggest line items where you're not going to be the only customer. And so it's a model we see and we use often very successfully. So kudos on that. All right. So clearly you've not let the lack of answers stop you from moving forward in your career. For entrepreneurs earlier on in their career who are feeling challenged, like they don't have all the answers, like what advice would you have for them about moving forward despite not having all the answers?
Well, I've had this question a lot, and I think a lot about Phil Knight, believe it or not, because people ask, to your point, like, how did you do it? And I'm like, I don't know. And I'm not kidding. Like, I don't know. It was in the unknown. It was literally in the unknown. And that's where growth happens. I said, I just did it. And then I think of Nike, and that's my thing. I was like, go buy a pair of Air Force Ones and just do it. That's the only way. Not having all the answers is where the value is. And that discomfort, as you said, is where the growth is. So being comfortable, being uncomfortable and not knowing, like being able to sit down and say to yourself from a risk tolerance standpoint, are you okay jumping off the cliff and building a plane on the way down? And if the answer is no, then you shouldn't be an entrepreneur. And not everybody should be, by the way. Like that's not there is a dark side of being an entrepreneur, and don't I know it? So don't think that, oh, I'm not an entrepreneur. So there is so much value to being a part of a team and working your way through certain things, and being an employee or being a partner or working your way through is a beautiful life. And there's so much more. And if I look back, ask me in 20 years, if this much stress and missing this much time with my kids and, all the other heartaches in the path. So that's not necessarily the path. And so, everybody this is team sports. Like you need to have someone with some sort of vision of something great. Then you have to have the other people that are executing. Then you have to have middle management. Then you have to have the construction worker on thing. You need this whole ecosystem for this big dream to work. And there is a place for everybody in that. And I think it's overly glorified what it is to be a founder and a CEO. But I tell you, Jeremy, between you and I, nobody wants my job. If they really knew what went on to get here, if they really knew the dark nights of the soul that had to be endured, the losses, the embarrassment, the shame, the suffering that came, I don't think many people would want my job. And I truly mean that. So if you are drawn from a passion and a purpose to serve at something that is so insatiable and is so jolting that literally pulls you out of bed every day to do it, then that's meant to be an entrepreneur. And if it's not that, don't do it.
Nice. Yeah. We say oftentimes entrepreneurship is not for everyone. It is for us select weirdos. So, you certainly have seen some of the bigger challenges that come with that. So now with the gift and benefit of hindsight, what advice would you have for your earlier self, earlier on in your career when you had these unknowns and you faced the things you now know about, but were brand new then?
Learn to meditate. because if you can't calm your nervous system and find a place of equanimity, and this is what Ray Dalio told me when I asked him. I was a young entrepreneur. I stood in line to talk with him at a conference, and I said, I asked him, arguably one of the greatest investors in history, certainly one of the largest hedge funds ever. And he looked at me and said, meditate. I was like, meditate? I thought you were going to say MBA. So anybody that's here that really wants to be an entrepreneur, go to a Dr. Joe Dispenza, go look up Dr. Joe Dispenza, watch his progressive retreat, go to a 7-day retreat if you want to, learn how to meditate, because until you can really learn how to control the voices in your head, it'll make so much distractions, cause so much trouble and so much dissonance that is very counterproductive. And I wish I would have learned and done it later. I'm a lifetime meditator. I meditate twice a day at least, at least an hour a day, sometimes 2 hours or 3 hours. And that is an investment in my mental clarity. That is an investment in my empathy. That is an investment in myself so that I can serve.
I love that. All right. On the numbers side, you and I are both numbers guys. We love the KPIs, the metrics, how we know if we're on track or not. Like, what are the key numbers you and your team talk about at your stand-ups or that are on your dashboards to see if you guys are on track or off track and where the business should be?
Well, look, it's all about value creation, right? So what we're constantly looking at is where have we created value and made progress? And that is the systemic undercurrent of every single thing we do. What's a zoning case? We're looking at what's the step-up value going to be. If we're talking to our retail capital raising team, we're looking at how can we lower that cost per lead, which is creating value. Because and I know it sounds very rudimentary, but focusing on the systems that are creating value. Where is value being created? At the team level, and that means profitability. That means net operating income. That means lowering expenses, and I know these sound like very rudimentary things, but so many times people get lost in this operational nuance of we should be doing brand, I don't know. But where is the value creation and how can you measure that value is created? And asking the team in every call, how much value did you create this week? Did you save money or make money?
Nice. All right. Before we wrap, Ari, a few quick rapid fire questions. If you were to start all over again from scratch, what one lead source would you go all in on?
I would go in on using AI tools to scrape Reddit for different people, asking and figuring out what people are actually wanting to do and finding sources to curate people that have actual insight and intention to do a certain thing, no matter what the customer is, no matter what the business is, and bring people in with that intent and create customized ways to talk to them.
Nice. All right. Aside from your business growth playbook and The Gift of Failure, what are some of your top favorite business books?
I think The Intelligent Investor was very, very powerful for me. I think a book recently that really was effective for me was The $1 Trillion Coach. It's an incredible book about Eric Campbell, who coached a bunch of the Google guys. It was incredibly helpful. And I think that the book that anybody that wants to be an entrepreneur should read, Relentless by Tim Grover. It is about Michael Jordan and Kobe Bryant's personal trainer. He wrote the book on the things that took them from good to great to unstoppable. And it is about the mental comes. If you read The Intelligent Investor, you'll learn everything you need to know about the technical of investing. The rest is a mental game.
Yeah, I'm hearing that theme a lot. The technicality part can be learned. The mental stuff is really what's been powerful.
Yeah, that's the point. ChatGPT can tell you the technical part. Ask it to build you a model. But figuring out how to raise capital and build relationships and talk through people, now that's an art.
All right, last rapid fire question for you. Who was one of your most unlikely mentors?
I think my various meditation teachers. I think that's the part that, and I've talked about it a lot, but that part of my journey, of the people that I've learned, my other people that are in these courses with me, some of the youth, some of the long time meditators, but really learning that part, because I'm telling you, this is a mental game. This is going on between the years, and really learning that journey from the ancient wisdom that have undergone these stresses, endured them through wars, the Stoics, just this mental part, because like I said, the mechanics of running a business is not that difficult. It's really not that difficult in the grand. Maybe if you're some technical trader, I don't know, like running commodity with an algorithm, but running 99% of the businesses, are about sales, expenses. It's a very, it's when you shave it down, and you should, but the endurance and the mental ingenuity that it takes to do that, that's a different game.
Nice, Ari. So to recap for our listeners, you moved from being a law student raising equity on cold calls to partnering with specialists, eventually codifying your own scientific diligence systems and performance-first structures to build a billion-dollar real estate empire. And for listeners who want to learn more about you, Ari, where should they go right now?
You can go to rastegarcapital.com. You can find us on LinkedIn at Rastegar Property, or some variation of my name or my last name on LinkedIn. And you can find the book, The Gift of Failure, on Amazon, or listen to it on Spotify or Audible. But Rastegar Capital will have a lot of this insight into the investment business itself.
Excellent. Well, Ari, thank you again for joining us. This is great to have you on and to hear your story and the incredible obstacles you faced repeatedly along the way and how you found your way around those and what's allowed you to do that. So thank you for sharing with us.
Thanks, Jeremy.
Thanks so much for listening. Quick reminder, hit that subscribe button right now so you can get more episodes when they come out automatically. And remember to leave that rating and review right now.